Types of financial derivatives. A complete guide. What are financial derivatives? Financial derivatives are contracts whose value is based on an underlying asset, such as a stock, currency, commodity, or index. Traders, institutions, and corporations use them to hedge risk, enhance returns, or speculate on price movements. Example: a U.S. airline might use oil futures to lock in fuel prices. A trader may buy options on the S&P 500 to profit from expected volatility. Let's explore the four main types of financial derivatives. 1. Futures contracts. Standardized and exchange-traded futures are agreements to buy or sell an asset at a set price on a specific future date. They trade on regulated exchanges like the CME Group. Example: a trader expects gold prices to rise, so they buy a gold futures contract. If prices go up, they profit by selling the contract before or at expiration. Futures cover many assets: commodities, forex, indices, and more. 2. Forwards. Custom and over-the-counter. Forward contracts are private agreements between two parties, typically customized and traded over-the-counter, OTC. Example: a multinational U.S. company uses a forward contract to protect European revenue from euro-dollar exchange rate changes. 3. Options. Flexibility with defined risk. Options give the right, but not the obligation, to buy, call, or sell, put, an asset at a set price before a given date. Example: an investor buys a call option on Apple. If the stock rises, the investor gains, but the loss is limited to the premium paid. 4. Swaps. Managing interest or currency risk. Swaps involve exchanging cash flows, commonly used to manage interest rate or currency exposure. Example: two firms exchange fixed and floating interest payments to manage rate fluctuations. Understanding derivatives empowers traders to manage risk and seize opportunities. Whether you're using futures to speculate or options to hedge, mastering these tools is vital. Subscribe to FXCM for more expert insights into smart trading strategies.